Hi, my name's Eric Allen. I'm the CEO of Clarity, and I'm here with Jean Rolston. Jean's a CPA and Director of Taxes at RBSK Partners. RBSK has multiple locations here in central Indiana. And so thank you for joining us today, Jean.
Well, thanks for having me, Eric.
Well, as a nonprofit, Jean Clarity, and I know you all work with several nonprofits. For us in particular, about 70% of our income is from donations from supporters who are just passionate about what we care for, the thousands we serve, and a significant percentage of those donors are really businesses and individuals. And earlier this year, some new tax legislation came out, and I know that's been sifted through here for some months. And I've spent some weeks reviewing the coming changes and getting information. But really, we want to provide some things for our donors and others that they should be aware of the impact that the donations could have in their tax deductions on charitable giving, either the end of 2025 here, but also in 2026. And I think it would be helpful for viewers if we just kind of go through those changes and then maybe some potential ways that a donor might be able to maximize or best navigate them. And so let's kind of jump into those new rules.
Okay, that sounds great.
Sounds good. Well, one of them that comes to mind is a universal deduction for non-itemizers that I've read about. What is that? And can you explain a bit about that?
Sure. So that's new with the act that passed this past summer. And it starts in January 1st of 2026. So it doesn't affect the 2025 taxes. But this is for individuals who do not itemize. So they don't have enough deductions to itemize. They're taking the standard deduction. But in addition to that, they can deduct $1,000 if they're single or married filing separate, $2,000 if they're married filing joint of cash contributions to qualified charities. And that's in addition to the normal standard deduction. This does not apply to non-cash gifts like things to Goodwill or things like that, but it does have to be cash to qualified charities.
That's a good question. You mentioned non-cash gifts, things like we call them in-kind donations, which could be things of stock, stuff of that nature. Would that still fall within the deductible allowance?
No, it has to be cash.
Okay,
for this deduction, it has to be cash.
Very good. Well, it's good to know because it's a definite distinction that we get.
Yes.
Also, there's a question of a higher deduction floor. Who does that apply to, and why? What does it mean even?
So again, starting in January 1st of 2026, individuals who itemize now have another floor that we have to worry about. So this is 0.5% of your what they call the contribution base, which is basically your adjusted gross income, is going to be a reduction on your donations. So basically what they're saying is if, well, I'll just give you an example in some dollars. If you have adjusted gross income of $300,000, then you wouldn't be allowed to deduct the first $1,500 of your donations, which is that 0.5%. So say, for example, they had $20,000 in donations and they had that AGI of $300,000. They would only actually get a deduction for $18,500.
Very good. That's a different kind of calculation that we've not had before then.
No, that is correct. It's similar along the lines of like medical deductions where you can only deduct what exceeds 7.5% of your adjusted gross income. So this basically is along the same lines where you can only deduct your donations if they exceed 0.5% of your income.
And they have to deduct that 0.5 then from that actual donation then.
Correct.
Yeah.
Correct.
So is it applied differently, for instance, whether it's an individual or an S Corp or a corporation business? Is it applied any differently to those individuals?
It is. So the rules I described were for individuals. And so if you're an S corporation or a partnership, when you report your donations, they are actually a separately stated item that flows through a separate line item on the K1 to the individuals. So on the individual's return, those donations made by a corporation, an S corporation or a partnership are actually treated on the personal return as if they were made by the person. So they're going to be subject to those same limits.
Okay.
A C corporation, on the other hand, is not subject to this limit. So they would not have to go through the same hoops that the S corporation owners and partnership owners have to go through.
Is there any floor that does apply to a C Corp, a corporation?
Yes, there is a 10% limit that they can make contributions up to 10% of their taxable income. And then there's also, they have a 1% floor that falls into play too, starting in 2026.
Okay, so that's the 1% versus 0.5%.
Yes, yes.
Gotcha. Very good. Well, thank you. And one of the terms that I've seen used for exceeding a deduction floor is something called donation bunching, where more than 1 year's of planned charitable contributions are given in 1 year. And some of that might be before the new tax rules go into effect in 2026. How might that be done, and who would that even benefit?
So, well, there's a couple of reasons that it might be beneficial. One, like you mentioned, before the new tax laws come into play in 2026. So if you can make additional donations in 2025, they won't be subject to that new limitation, that new floor. So you won't get that phase out of part of your deduction if they're made in 2025. Additionally, if you're bunching 2 years together, you might be able to, like some years you give smaller deductions and it's not enough that you can itemize. So if you choose to bunch and then you have all your deductions, say 2 or 3 years worth of deductions, you make them in 1 year. In that year, you're going to have enough donations to itemize and be able to get those additional benefits. If you make it in 25 versus 26, you won't have the floor that's going to shave off part of it if you wait till 26 to do that.
And then in 26, you can claim that additional $1,000 or $2,000 where you can't this year. So bunching this year would be advantageous over next year.
Correct. Absolutely.
Very interesting. And how do individuals, do they just have to donate that extra amount directly to a charity, or are there other avenues that they can use to donate those into 1 year to bunch them together?
So, like you said, you could just go directly to a charity. One of the other things that you could do is a donor advised fund. Okay. So with donor advised funds, the year in which you give the donation to the fund is the year that you get the donation deduction on your return. Now, within that donor advised fund, as you're aware, those funds can continue to grow and be distributed out to charities at a later date. So you don't get an additional deduction when that donor advised fund makes a contribution to the actual charity. You just get the deduction in the year that you put the money into that fund.
Yeah, and we get quite a few donor advised fund donations, and it is a way that I have seen that donors can claim the deduction in a single year, but then continue to bless those nonprofits throughout for future years.
Exactly.
Than them not continuing to receive the benefit of their charitable giving.
Exactly.
Very good. Charitable deduction caps are also a subject that we've heard of, and there's a new cap to that. What is that, and who does that apply to?
So there's 2 little items here I want to talk about under the cap. Okay. The first one is there is a cap on the total contributions that any one person can make in a year. Cash contributions can't exceed 60% of your income. And if you have appreciated non-cash assets like stocks, for example, they're limited to 30% of your income. So these would apply to the individuals, especially those who want to give significant portions of their income to charity. They've got to make sure they don't exceed those caps. Otherwise, it will be it could be carried forward to the future, but you could deduct it in that current year.
But so the option is that they can't deduct it. They could do it if they weren't concerned about the deduction, but they could deduct it. Okay.
Correct. And then there's another cap that starts January 1st of 26 for those high income earners who are in the 37% tax bracket. So for those earners, if you're in the 37% tax bracket, they shave off another piece of your charitable donations and say that you can only get the deduction is capped at 35%. So you lose 2% if you're in one of those high income earners in the 37% bracket.
So they can give 35% and they'll get 35, but if they give 37%, they're still just going to get 35%.
Well, it depends on where their income is.
Okay.
So if if they're in the tax bracket, the 37% tax bracket, then whatever they give is going to be limited to as if they were in the 35% bracket.
And is there any way that they can navigate that? Could bunching apply to help them as well in their donations this year?
I mean, it could, because you're getting your higher donations. You're still going to get that small part shaved off. Just for reference, the income threshold that gets you into the 37% bracket for 2025 for married filing joint filers is 751,000.
Mm-hmm.
So it's got to be your significant earners who are going to fall into this cap. The other ways, if there have any other ways to lower your income to get you out of that 37% tax bracket, and then that this phase out wouldn't apply to you.
Okay. So it's only the more select tax bracket than the general population necessarily.
Correct.
A couple percentage at that tax bracket also makes a significant amount of difference.
Correct.
As well, farm. Okay. Thank you. That helps. There's a SALT deduction cap, and
Yes.
It's an acronym that if you're not used to it, it's state and local taxes. So there's some changes there. Would you mind kind of sharing what those are and who that applies to?
Sure. So, well, the state and local taxes includes your state income taxes, as well as real estate taxes that you pay on, like, your house, for example. And it also includes personal property taxes that you would pay, like, say, your auto excise tax on your cars. So all of those are included in the state tax deduction. And if you happen to live in a state that doesn't have a state income tax, you can instead look at the sales tax for the state, and they have calculations that they use. You don't have to go and find all your receipts to see how much sales tax you actually paid, but based on your income, they use percentages to get that. So say you had a Florida resident who has no state income tax, they could use the sales tax instead.
Okay.
But what changed for 2025, so in 2024, the SALT tax deduction is limited to $10,000. So no matter how much you paid in state taxes, including property taxes, the most you could deduct was $10,000. So starting in 2025, and this is right now, it's only 2025 through 2029. The deduction has been raised to $40,000 for married filing joint, 20 for married filing separate. But again, if you're one of those high income earners, it's going to get phased back out. So if your income is between 500 and 600,000, it's going to phase down from 40,000, and then if it's over 600,000, it goes back to the $10,000 limit deduction. So, like I said, those high income earners, they're back to where it was in 24 with the 10,000. If your income is under the 500,000, then you will get the $40,000 deduction.
Okay. And so a lot of people probably aren't aware even or don't pay attention to SALT if they're doing standard deductions, right? The standard state and local. And so can state and local taxes, can this new SALT deduction ability, can it be combined with charitable contributions so that a person could go above itemization that they couldn't combine those before?
Absolutely. So your total itemized deductions include your charitable contributions, your SALT, your state taxes, mortgage interest as well, okay. Medical, if it exceeds that 7.5% of your AGI, and then gambling losses to the extent you have gambling winnings, but can't exceed your gambling winnings. So yes, the total of all of those is what you would compare to the standard deduction to see which one is better for you. So yes, you would definitely include. So as you can see, the SALT deduction can be up to $40,000. So that alone is more than the standard deduction for 2025.
Yeah, and for this year in particular, in 2025, then where somebody may not be able to claim their SALT, if they doubled up in bunching their contributions, then all of a sudden they also get the additional aspect of SALT to include in that itemization. So that multiplies even a little larger for them.
Absolutely. So yeah, I mean, the last few years, the number of people who've itemized has dropped substantially. So I think this year it's probably going to turn around with the combination of the SALT deduction and, like you said, the fact that in 26 these additional limitations are coming into play for charitable deductions. I think more people will be giving charitably in 2025 to basically take advantage of the fact that those limitations aren't there yet for the charitable deductions.
Yeah, and as I think about that, just from a numbers perspective, somebody that might give 20,000 a year charitably hasn't claimed that for years because it's not gone over the itemization amount.
Yeah.
But if they increase that, double that this year to 40, bunch their stuff this year to 40, then they get to add their state and local taxes, and if that ended up being another 2 or 3,000, then they're another 10, 13,000 above their standard deduction all of a sudden.
Exactly. That's
And
exactly
so
right.
would they apply their tax bracket then to that number above, say round number, if they were able to claim 10,000 above their standard deduction, would their tax bracket such as 22% be how much they would save?
Roughly. I mean, if they're in an even spot within that bracket, yes, that's correct. I mean, sometimes you're based on your income, you might fluctuate between two brackets, so it might not be exactly that, but yes, ballpark, absolutely. Your additional deductions times whatever tax bracket you're in would be the amount of benefit that you're getting for those deductions. And for point of reference, for 2025, the standard deduction is 31,500 for your married filing joint, 15,750 for your single taxpayers.
Very good. Yeah, and you bring up the subject of standard deduction. A lot of people just take their taxes to somebody such as yourself or others, and they do those. So they may not understand really what's meant by standard deduction. Can you explain what that is a little bit and how it affects a person's ability to claim charitable contributions?
Sure. So your standard deduction is basically it's a fixed dollar amount that the IRS set that is adjusted annually for inflation, so it changes a little bit every year. That is directly reduces your taxpayer's income that's subject to tax. So typically, if you take the standard deduction, you don't also get to deduct charitable contributions. However, as we noted earlier, that changes in 2026 because in 2026 they are allowing $1,000 or $2,000 of charitable donations in addition to the standard deduction.
Yeah, and you mentioned earlier some of the things that can be included in an itemization for the average household, charitable contributions, now SALT, and then medical if it reaches a threshold. Are there other things that could be included in an itemization for an individual?
The other most common one is mortgage interest.
Okay.
And then gambling losses, like I said, to the extent of gambling winnings. And if you do have a casualty loss, that could fall in there as well too. But typically the ones that we see the most often are your mortgage interest, your state and local taxes, and your charitable donations.
Are there things that a person, they may not have enough to claim beyond a standard deduction, but they could add to in the way of charitable contributions to, if they were able to increase their itemization, depreciated stock, life insurance policies, just non-cash assets that are donated? What could those be, or how would those work for an individual?
So one of the benefits of donating appreciated assets, such as stocks, is that if there is an unrealized gain on those stocks, so for example, you purchased some stocks for $5,000 many years ago, and now they're worth $20,000. So if you sold them, you would have a capital gain of $15,000 you'd have to recognize. Okay. If instead you donate those stocks, the actual stocks, to a charity, you recognize zero gain, but you get a deduction of $20,000, which is the value of those stocks. So like you said, even if you're not itemizing, you are reducing your income by $15,000 because you're not required to recognize that gain. Now, if you would actually sell the stocks, get the cash, and give the cash to the charity, then you have to recognize the gain. So if you have appreciated assets, always see if you can find a way to transfer them in their current state and not sell them for the cash to prevent that gain recognition.
At Clarity, we have a brokerage account just for that people can contact us and get the information, the DTC number and things for that donation that way. And does the same apply for like life insurance policies or a whole life and other non-cash assets as well?
Generally, yes. I mean, if you transfer something with value, you would not recognize any gain on that. And you would get the deduction for whatever the value of that non-cash asset is.
Okay, very good. Uh, Something that we touched on earlier is called donor advised funds, and I think a lot of people aren't familiar with what those are. And you're not an investment person, but you're a tax person that knows the tax side of this. But can you share just kind of a little bit what is a donor advised fund, and a little bit of how a person might utilize that more in depth?
Sure. So for the donor advised fund, it's basically a fund, like you mentioned, at somewhere like Clarity, where you, as an individual, I might give a significant contribution to this fund at one point, so I can get a larger donation deduction on my personal return. But I'm not yet ready to figure out what specific charities I want that money to go to. If I put it in this donor advised fund, I get the deduction right now for the money I put in there, and then I can choose to, over this next several years, make contributions to charities out of that fund, because some charities also don't have a harder time handling large donations, and it's easier for them to get smaller donations over a period of time rather than one significant donation. So this kind of fund would allow you to spread your donations out over a period of time, but also, on the other hand, you're still getting the large donation deduction in the year you fund that donor advised fund. So you're kind of getting the best of both worlds that way.
Yeah, and that's the next year. Then an individual could claim their standard deduction, for instance, if they use donor
Correct.
advised or something of that nature. We do, just for those who aren't familiar with them, we get donor advised fund distributions periodically. They're referred to as grants by the donor advised fund. Usually, that somebody has suggested, so the donor makes a suggestion to the host of that, and those are usually available, that we find anyway, through a financial advisor for their IRAs or things of that nature. So it might be a charity, Fidelity or Schwab or Vanguard or whoever charitable fund that those come from. Edward Jones and others. So there's a lot of them out there for
Absolutely.
that, but many don't use them because they're unfamiliar with, or they think they have to have a high wealth value to utilize those, we find.
Correct. Correct.
Very good. Well, thank you for that. There's another one that kind of moves into a different age bracket that doesn't apply to everybody. Any age can use a donor advised fund, correct?
Absolutely.
Yeah. Another age that we move into, though, it comes into this to more of the retirement ages, called required minimum distributions and qualified charitable distributions, or RMDs and QCDs. Let's just start off with, what is a QCD, or qualified charitable distribution? Who does it apply to even?
So a qualified charitable distribution is basically it's a tax advantage way for individuals who are at least 70 and a half or older to donate up to, for 2025, it's 108,000 directly from an IRA or directly from an IRA to a qualified charity. So it works for traditional IRAs or rollover IRAs, and so it comes out of the IRA and goes directly to the qualified charity. So the individual can't get the check and pass it on. It has to go directly from the IRA to the charity. And by doing it that way, it actually reduces the adjusted gross income. So not as an itemized deduction, but as an income reduction on the face of the return. So it brings down your adjusted gross income, not just your taxable income. So one of the benefits of that is that not only does it reduce your federal income, it reduces your state taxable income, where itemized deductions, the state does not allow charitable deductions or any other itemized deductions. So if you do your regular charitable itemized deductions, it doesn't affect your, for example, Indiana return. Where if you do a QCD, then it does reduce your income for Indiana purposes as well.
Now, would that also save on anything such as, how would capital gains come into place for a traditional IRA for somebody doing a QCD? Is that a benefit to them in that sense as well?
Well, it could be, because that QCD reduces your adjusted gross income. If part of your income is capital gains, you could potentially fall into a lower capital gains tax bracket, And depending on where you are, capital gains, long-term capital gains can be taxed anywhere from 0% up to 20%.
Wow.
So the lower your income bracket is, then the lower the capital gains rate that you will be subject to. So by reducing your actual income, and not as an itemized deduction, but your income using the QCD, you could potentially pay lower capital gains rates, which also qualified dividends are also taxed at the capital gains rates. So not only just capital gains, but also qualified dividends as well.
Very good. And that's 108,000 this year for an individual. If there's a couple that are filing jointly, then could they claim that per individual?
Yes, that is correct.
So then it becomes 108,000 for a husband, 108 for a wife, so a total of 216 for a couple. And
correct.
Okay.
Yeah, so that's some significant income reduction if if you're charitably inclined and your IRAs are big enough to support that. And you mentioned the RMD, the required minimum distribution, which basically that is IRAs require you to take out a specified money out of your plan every year. This QCD can be used to satisfy that RMD requirement. Okay. So while you're required to take it out, normally you pay tax on it. If it goes directly to a charity, you're still meeting that requirement to take the money out, but there's no tax on it because it's a qualified charitable distribution.
So in what age does the RMD come into play?
So the RMD comes into play, it depends on when you were born. So for those born between 1951 and 1958, it's 73. If you were born 1960 or later, it's 75. The QCD used to be tied to the retirement age when RMDs were required, but a few years ago, they kind of split off. So like I said, the QCD can start as early as 70 and a half, but the RMDs either have to start at 73 or 75, depending on when you were born.
And the RMD, is it another one of those things where they need to have it sent directly to the charity from their advisor or from their IRA fund?
Well, the RMD, required minimum distribution is just the money you're required to take out. If you take it personally, it's taxable to you. If you give it directly to a charity, then it would qualify as a QCD and not be included in your taxable income.
So they need to specifically mention that to their financial advisor that
Absolutely.
They want to do that as a QCD.
Yes. And I don't know of any financial advisors who aren't able to handle this, and they're very comfortable with doing it. So it should be a matter of, like you said, a discussion with your financial advisor, and they should be able to handle it with ease. So.
Yeah, and just a disclaimer to see their own personal tax CPA or tax filing expert, and
correct,
instead of just going by because these are very loose details, clearly.
Absolutely.
General rules. Are there any other things that you can think of that individuals that you see just as a tax professional, a CPA, that they may be overlooking in their charitable contribution, or that they aren't aware of? And that's a broad question, I know.
Yeah, I think the big things we've already hit on. I think the QCD is a big thing that people frequently aren't aware of, the benefits with that. And I think the other big thing people frequently aren't aware of is when you donate appreciated property, not being required to pay tax on that gain. So I think those are the bigger things I think that come into play that people frequently aren't aware of.
Just curiosity on the subject of people giving out of their IRAs, for instance. People at 59 and a half, depending on, I'm sure there might be a year aspect to it, but they can start withdrawing from their IRAs without early withdrawal penalties, correct?
Correct. If you're under 59 and a half, there are some exceptions that you can get out of it, but there potentially could be early withdrawal penalties. So you just need to make sure you're very careful if you're under 59 and a half. But once you get over that 59 and a half, then the penalties go away.
Yeah, but between 59 and a half and 70 and a half, the QCD doesn't come into play.
Correct. So anything you take out would be taxable.
Okay. And could they, though, instead directly transfer those stock to a charitable to reduce capital gains or things of that nature at all? Would that apply at all, or does that only apply to QCDs?
It only applies to the
Very good.
QCDs. Yeah.
Yeah,
Yeah.
and that's a good clarification because
Yep.
not everybody realizes that.
Yep. Yep.
Well, very good. Well, I thank you for your time today, Jean. It's been a real pleasure and good to learn from a tax professional that works in this all the time, some of the nuances from the changes that are coming to help our donors and others with it.
Well, thank you for having me, and I appreciate being able to provide this information to you and your customers, your clients.
You're welcome. And if you don't have a tax professional, certainly consider RBSK and how they can help with your needs. You've got numerous locations around the central Indiana area.
Absolutely.
And so I know very capable of providing the professional assistance that individuals can need. So thank you again.
Thank you.